I'm Jingjing Huang, Credit Product Strategist. Welcome to our quarterly Asia Trade Floor update. Joining me today is Portfolio Manager Stephen Chang.
Thank you for having me, Jingjing.
So Stephen, you were recently in London for PIMCO's September Cyclical Forum. Could you please share with us the key themes that were discussed?
Sure. In fact, it was the first PIMCO forum hosted outside the US. A timely location given the UK's economic situation reflects many cross-currents happening around the world. In our view, there are three key themes to watch over the next 6 to 12 months. Firstly, central banks are reaching the end of their tightening cycles, and we believe both growth and inflation have peaked. Among developed market economies, we expect weakness ahead as fiscal support dries up and the drag of tighter monetary policy is felt more forcefully. Secondly, markets currently appear to be priced for an optimistic soft landing outcome.
And that seems counter to our outlook.
Indeed, we have analyzed 140 tightening cycles across developed markets all the way back to the 1960s and found that historically, when central banks hike by more than 4%, avoiding a recession would be unusual. The third and final theme is we believe this collective slowdown may play out differently across countries, depending on their interest rate sensitivity. Structural differences in housing markets and mortgage financing will play a role.
Will China's slowing economy be a factor as well? Earlier this year, the IMF forecasted that China would drive a third of global economic growth in 2023.
The country's recovery has been weaker than expected, weighed down by the property market. Monthly housing investment, which had been expected to stabilize, is down 11.2% year over year as of September. Our baseline GDP growth forecast for 2023 remains at 5%, and recent activity data has been somewhat better than a beaten down market expectation. Greater fiscal support has boosted infrastructure investment, and monetary easing has helped manufacturing investment, pulling up industrial demand. However, more stimulus is likely needed to stabilize China's property sector and the economy more broadly. There are risks if the stimulus is insufficient or too slow to arrive. In our downside scenario, we see growth in 2024 possibly slowing from our baseline of 4.4% to about 3%. This would suppress China's demand for global goods and services and weigh on the global economy.
So what is PIMCO's Asia investment team seeing on the ground from China?
We think the government still has the capacity and tools to avoid such a downside scenario. More fiscal support, including infrastructure capital spending and tax cuts, could help lift domestic demand. China's policy rate is now at 2.5% and believe a further reduction is likely. The government has recently called for more counter-cyclical macro policy to prevent the economy from a severe deceleration.
With China entering an era of slower growth, along with an aging and shrinking workforce, weak consumer demand, and a property market downturn, there is debate on whether China is facing a balance sheet recession, which is similar to Japan in the early 90s. What is PIMCO's perspective there?
We believe there are some similarities, but also two key differences. First, the corporate deleveraging that started in 2014 was engineered by the Chinese government, aimed at reducing risk, whereas Japan was driven by the private sector. Secondly, China's household balance sheets are well cushioned by high savings, with a savings rate of about 30% versus around 15% in Japan. Rebalancing will be key to finding ways to grow household income and thereby consumption. There's also scope to improve capital efficiency through innovation. Incremental urbanization and hukou reforms could help mitigate the population aging problem. Overall, there's potential for improvement in terms of output, consumption, and infrastructure per capita.
Given all this, how are we approaching China at the moment?
We are watching for a turning point in the data before we get more constructive. We have had a more cautious view of China for most of this year, and there has been some disappointment in growth in second quarter and third quarter. However, policymakers seem to be willing to adopt more supportive measures, though it may take time to further ramp up and have an effect. We don't want to jump in too early.
So if we look beyond China, in the context of a global portfolio, how should investors position for the year ahead?
We believe the outlook for fixed income returns looks good, given the high level of starting yields and the risk of recession. Our focus is on the global opportunity set and diversifying our sources of duration. We also want to maintain flexibility and liquidity. Most importantly, position for a broad set of macro and market outcomes and not just the baseline.
Given today's heightened economic and market uncertainty, that sounds like a prudent approach. Thank you, Stephen, for your time today.
Thank you for having me.
Goodbye.